Hello and welcome to Business Today Television. I'm Siddharth Zarabi, and with me today is Mr. Keki Mistry, the Vice Chairman and CEO of HDFC Limited, one of India's largest private sector lenders, and the boss of a company which is described as Rahul Dravid, consistent and always solid. Mr. Mistry, very warm welcome to Business Today Television. Some people are speculating that this could be the last time that you will present standalone HDFC Limited numbers because of the impending merger with HDFC Bank, but I'll come to that point later. I want to begin by asking you to comment about the fantastic set of numbers which have taken the whole street by surprise. What went behind this surge in profitability?
Right. So let me explain to you. The demand for housing loans has continued to remain strong. If you look at the month of March 2023, we had the highest level disbursements in any month in HDFC's 40 plus years of history in the month of March 23. So growth momentum is strong. Our economy at this moment is on a very, very strong footing. I think we have to compliment RBI, compliment the government for all the measures that they've taken over the last 3-4 years, particularly after the onset of COVID, which has set our economy on such a strong growth path. So March 23 saw very strong disbursement numbers. That is one reason. Second is consistently over the last several quarters, particularly after the peak in September 2021, when the COVID impact was at its highest, NPL levels had gone up. We've every quarter after quarter, we've seen the levels of NPLs come down to a level today when they are, if you go by the old method of calculating NPLs, they are what they used to be at their best in 2014-15. So very, very good asset quality. Gross non-performing loan, even under the new norms of RBI for individuals, is 0.75% gross. And if you go by the old norm, that will be somewhere around 0.65, 0.66%. So strong asset quality. And the third and the most important is transmission. We've said before also that when RBI increases interest rates, our liability cost increases immediately. But whilst we increase the retail prime lending rate for our customers, the impact of the retail prime lending rate comes in only over a period of 3 months. So 1/3 of the loan will get repriced in 1 month, 1/3 will get repriced in the second month, and the 1/3 will get repriced in the third month. So on an average, it will take about 1.5 months for the entire transmission to take place on the asset side. So there is always that transmission lag, which leads to a slight reduction in the net interest margin in a quarter in which there is sharp increase in interest rates. Now, what we've seen in this quarter is that the benefit of the increases in interest rates are now fully set in. So we don't have that lag in. So that is the primary reason why you see net interest margins higher. And the other, of course, is the fact that as asset quality improves, asset quality gets even better, you start accruing more income on the loans where earlier we are not. This is a combination of it.
Okay, the assets under management at 7.2 lakh crore. Throw a bit more light on the quarterly performance and how do you see it panning for going forward?
All right. So the assets under management have two broad categories, individual loans and non-individual loans. Individual loans constitute 83% of our total book. 7% of our loans are construction finance. 6% of our loans are lease rental discounting loan, and 4% are corporate loans. So 83 plus 7 plus 6 plus 4 will be the breakdown of our total loan. Now, the individual segment has been very strong. As I've been telling you in the course of this interview, individual momentum is strong, and my expectation is that the momentum will only increase over time. Now, when you come to the non-individual segment, particularly the construction finance book, the period from 2017 to 2020 saw a slowdown in the real estate sector. So there were not many projects that were launched during that period. Now, the disbursement for a project which is approved only comes over a period of time. The disbursement is never front-ended; it tends to be more back-ended, or over the period of construction. So, if from 2017 to 20 there were no new projects launched, and project launches only started after say mid to late 2021, the momentum build up that you will see in the book will only come over a period of the next 2, 3, 4 quarters. So that's the reason why the construction finance book has not grown, has actually degrown. The second reason is the fact that, as we were all this while regulated as a housing finance company. When we move into the bank, we will be regulated under the RBI. So there is some difference in the kind of loans that banks can do and what we can do. So to the extent that there was a mismatch and there were loans that a housing finance company could do but which a bank cannot do, we paid down those loans. So there's been roughly a 18 to 20 odd thousand crore paring down of non-individual loans in order to be compliant with the rules applicable to a bank. So these are the two main reasons.
Uh,
That's why
um,
if you see the loan book growth, if you
yes,
see
please.
the loan book growth, individuals is 17% and non-individuals is negative 12%. Now, negative is largely because of the paring down to make it bank compliant.
Okay. And do you see this changing in the quarters ahead, or would
I
this?
would, I would, yeah. So I would expect the individual momentum to continue,
Mhm.
particularly when it moves to the bank. I would hope that the momentum only increases because the bank has far larger distribution network than HDFC has, 7,000 plus branches. So over a period of the next few quarters, couple of years, the bank should use a very large part of their branches to be able to distribute housing loans for us. So the distribution platform would become huge. Secondly, if you look at penetration, only 2% of the customers of a bank have a housing loan. Only 2%. 5% have housing loans from other banks. So look at the ability to cross sell to the 93% who do not have a loan at all and to the 5% who have taken loans from other banks. So it's in my opinion, a very, very big growth opportunity in the coming quarters.
Okay. The net interest margin came in at 3.6%. Since you speak about the growth opportunity in the future, do you also see margin expansion?
See, historically, our guidance has always been that in a HDFC Limited structure, the margins would be in the range of 3.3 to 3.5. That has been our guidance over the last several quarters, several years. This year, it has ended up at 3.6%. Now, what will happen is when we transmit, when we move to the bank, then the liability repricing will start. We do not have access to CASA deposits, current account, savings accounts, deposits, which are at a much lower cost. So as existing liabilities get replaced by lower cost of funds, you should see the net interest margin in a banking structure also moving up.
Okay, okay, that's a fair point. I just want to dial back on the non-performing asset bit, where there is a significant improvement, but at a gross level, they seem to have stayed higher at 2.9%. Can you expand on that, and do you see some sort of moderation happening in the near future?
No, so 2.9% is the lowest in the only in that 17% book, which is non-individuals. 2.9% is not on the total book. On the total book, it is 1.18%.
Okay.
0.75 individuals and 2.9 for non-individuals. Now, non-individuals, which is now 2.9%, at the peak of COVID had gone to nearly 5%. And gradually, progressively, quarter after quarter, the non-performing loan numbers have been coming down. But don't look at only one segment of the book, look at the entire. On an entire book basis, a gross non-performing loan number now stands at 1.18%, and we were at nearly 2% during COVID.
Absolutely, that's a great improvement. Let me ask you about the real estate sector. Given what has happened with interest rates, and you spoke about transmission as well, what's your view, and also a bit about the kind of projects we are saying? For some time, we've been reporting the belief that affordable housing is pretty much dead, and the upper end of the market is what is really moving, Mr. Mistry. Are we correct in our
I would
assessment?
I would put it this way that the period from 2017 to 2020, I repeat what I said earlier, was a period of stress in the real estate sector. And that stress was really coming in the high income brackets. Or let's not get into high income, low income in the cities.
Mhm.
So whilst the tier 2, tier 3 towns continued to grow in that period, the tier 1 cities started seeing a slowdown. You would have talked you'd remember people were talking of oversupply in Mumbai and
Hmm.
oversupply in Delhi. That is behind us. So now that the demand started picking up post COVID as a result of improved affordability, as a result of COVID induced demand, as a result of the fact that the governments offered a number of incentives for people to buy a house, because housing creates the most number of jobs, whether it is direct jobs in the form of construction workers, masons, carpenters, plumbers, or it is indirect jobs in industries like cement, steel, paint, power, and so on and so forth. So after COVID, there was a lot of incentive given to these industries, and consequently, job opportunities, all that rose. But as a result of all of that, the demand started picking up in a big way in the metros. So therefore, what you're seeing is now you're seeing an even balance of growth between the metros and the non-metros. With the metros growing slightly higher than the non-metros, but it's not as if the non-metros are not growing. They are also growing equally strong.
Will this sustain? Because for example, in a market like Bengaluru, where we've seen several layoffs, not in mass numbers really, and that perhaps eating into new demand. Do you think the urban growth story in real estate will sustain?
Yes, I think it will sustain. You are talking of a very small fragment of the market which deals with more to do with international players and the slowdown in the Western world, because of which you might have seen some layoffs in Bangalore. But the Indian economy is largely domestic. We are far less dependent on what happens in the US or UK or Europe or wherever else compared to, let's say, a China. And our domestic economy is extremely strong as we speak today. So I would expect the growth momentum to continue even in the metros.
Since we spoke about the international scenario, I just wanted to ask your views on what is likely to happen in India as far as interest rates are concerned. The RBI has taken a pause. Do you think it's going to be a long one?
In my opinion, yes. I said that even before during the last earning, I think in February or March when we spoke to various media people. My view is that inflation numbers in India are now under control, completely under control. Again, I must compliment RBI for the role they played in ensuring that, unlike what the Western countries did, we did not flush the economy with liquidity, which automatically would result in inflation. We managed the economy extremely well during that difficult 2020-2021 COVID period, and therefore we did not see the kind of tearaway inflation that the Western countries saw. And our inflation was more arising out of the fact that oil prices shot up, which were global factors which we had no control. So I don't see any further risk or any further likelihood of interest rate increases by RBI, in my opinion. There would therefore, to my mind, be a stability in rates for some time, and maybe at some point of time, difficult to tell you when, end of the year, early next year, you could perhaps start seeing, if everything is normalized, economy is not, I mean, the monsoons are normal, geopolitical issues for other countries are more or less settled, you could even start seeing rates come off a little.
Well, that's something that all of us would hope for. Mr. Mistry, before I let you go, I also want to comment from you on the merger timeline, the big one, HDFC Limited and HDFC Bank viewers, that is already been announced. What can you share with us?
It's very difficult for me to give you an exact date or exact, because there are so many emerging factors which are not in our control. Various kinds of we are not a single company. We are a conglomerate.
Hmm.
So we have RBI, we have NHP, we have SEBI, we have IRDA, we have pension regulator. All of them have been extremely cooperative, extremely, I must say, and extremely helpful. But there is still procedures which need to be carried out. So our expectation is that sometime in June, July is probably the time when the merger gets completed.
All
But this
right,
is an
Mr.
estimate.
Well, we will certainly hope for smooth sailing with that one, Mr. Mistry, and hope to talk to you once again
Thank
on your numbers as well as the real estate story of India. Thank you very much for your time with us today. With
thank
that, it's a wrap
thank
on
all the
this
best to you. Good
conversation.
luck.
Thank you. To you too, sir. Bye-bye. See you soon.
If you like the video, do like, comment, share and subscribe.